Welcome to week 11. We're going to be covering payment systems. So we'll cover common online payment systems, how payment systems function, how payment cards are used, discuss stored value cards and digital cash. We'll also go into digital wallets and how the banking industry is using internet technologies. So financial technology is the use of powerful internet-connected computers that use tools to improve the quality and reduce the cost of financial services. They enhance existing or they create entirely new financial products. This includes online payment systems not operated by banks. These alternative payment systems facilitate purchases and other money transfers and are convenient and becoming widely adopted. Financial technology has also revolutionized lending. Some of the common online payment methods are cash, checks, debit cards are the most common methods used to pay for purchases, and more than 90% of all U.S. consumer payments are one of those types. Electronic transfer is a small percentage, mostly automated payments from checking accounts. Credit cards and debit cards are used for more than 60% of online payments. Alternative systems such as PayPal are used for the remainder. They're convenient for customers and cost-effective for businesses. Electronic bill presentment and payment systems are designed to deliver bills and accept payments. Success depends on ease of use and time required. Consumers are choosing this option because of the convenience, and the number of consumers choosing this option are increasing. 70% of bills paid by check are now paid electronically, which is a huge savings in paper, postage, and time. Biller direct systems are used by large companies who want to manage the systems themselves. Consolidator systems aggregate all a customer's bills on one system, and this is mostly via banks. Micropayments and small payments are internet payments for items costing less than $10. Micropayments are for items costing a few cents to $1. Many companies have adopted micropayment systems, but none of them have gained broad acceptance. Small payments are payments of less than $10. They're offered through mobile telephone carriers, but they're held back by the substantial charges for providing the service. Of course, one of the largest markets is music downloads. Payment cards are plastic cards used for purchases. They have several categories: credit cards, debit cards, charge cards, prepaid cards, and gift cards. Credit cards, such as those offered by Visa and MasterCard, have a spending limit based on the user's credit history. You must pay off the entire credit card balance or pay a minimum amount and have interest charged on any unpaid balances. They're widely accepted and provide consumer protection. There's a 30-day dispute period. In e-commerce, the fact that the card is not presented makes transactions have a little extra risk for the merchant and the bank. A debit card moves funds from the cardholder's bank account and transfers it to the seller's account. These are cards issued by a bank with a major credit card issuer's name. Charge cards, American Express is an example, have no spending limit with the entire amount due at the end of each billing period. Retailers may offer their own store charge cards. Prepaid cards are called gift cards. And single-use cards have disposable numbers and they're valid for one transaction, but they have not been widely adopted by consumers. Some of the advantages and disadvantages of payment cards. One advantage for merchants includes fraud protection. Merchants can authenticate and authorize purchases using a payment card processing network. The advantage for U.S. consumers is limited fraud liability of $50, which is often waived if the card is stolen. Merchants view the per transaction and monthly processing fees as a cost of doing business. Consumers pay a slightly higher cost for goods due to these cards, and some charge an annual fee. A payment U.S. online and mail order stores must ship merchandise within 30 days of charging a payment on a card. There's a significant violation and penalties if they miss that, so most stores charge an account when the order is shipped. The processing of payment cards is a two-step process. Payment acceptance is establishing card validity and verifying the card's limit is not exceeded by the transaction, and that's payment acceptance. Clearing the transaction is the second step, and that includes all operations to move funds from the cardholder's bank account into the merchant's bank account. There's open and closed loop systems. With a closed loop system, the card issuer pays the merchant directly without a bank or clearinghouse. American Express and Discover Card are examples, and they issue cards directly to consumers. Open loop systems add additional payment processing intermediaries to the closed loop system. Visa and MasterCard are examples. They're issued by a local bank. Visa and MasterCard are credit card associations operating by customer banks who evaluate the credit standing, establish credit limits, and absorb non-payment losses. Merchant accounts. When an acquiring bank does business with sellers that want to accept payment accounts, sometimes the business must set up a merchant account with the acquiring bank to process internet transactions. One type that's similar to a checking account is with banks collecting accounts net of processing fees. Another approach is that the account acts like a credit line where the acquiring bank makes a non-interest-bearing loan in the amount of daily receipts, and it's reduced by the collection fees. Obtaining an account requires the merchant to provide business information for the bank to assess risk. Chargeback occurs when a cardholder successfully contests a charge. The acquiring bank must retrieve money from the merchant account, which may have funds on deposit. Acquirer fees are charges for providing payment card processing service. There's a per month and per transaction, and it's set by the acquiring bank. With merchant accounts, the level of fraud is higher online. Under 15% of all credit card transactions are responsible for 64% of credit card fraud. Some of the anti-fraud measures include scoring services that provide risk ratings for individual transactions in real time. Also, shipping only to card billing addresses and requiring credit card verification numbers, the CVNs, for the cards that are not present, of course, with online transactions. And the CVN is that 3 or 4 digit number printed on the credit card but not encoded on the card's magnetic strip. And here we see a chart of the forms of payment by their percentage. Credit cards are the largest. Debit cards are 28% of the market. Alternative payment methods like PayPal, 20%. Prepaid cards are 10%. And store-branded cards are 6%. And here we see a closed loop system. In this case, the cardholder purchases from a merchant. The merchant sends information about the sale to the card issuing bank. The bank deducts fees and pays the merchant. The cardholder pays their bill to the bank. And here we see an open loop system. Here the merchant sells a product to the cardholder, and the merchant gets information from the exchange network, and the credit card association operates the interchange network. Once the transaction is approved, of course, the purchase is made. The interchange network deducts a fee and then sends the balance to the merchant's bank. The merchant's bank deducts a fee and then pays the balance to the merchant. And of course, the card issuing bank pays the amount of the charge, and the customer pays the bill to the card issuing bank. So let's look at payment processing. Most online merchants accept both closed loop and open loop system cards, and some accept direct deductions from customers' checking accounts. Automated Clearinghouse, ACH, is a network of banks involved in direct deduction transactions. So this is where they take cash right out of your savings account or checking account, and you set that up in advance for them to do that. Processing depends on the size of the business. Large businesses build and manage their own systems. Mid-size use purchase software with skilled staff to manage the system. And small businesses rely on service payment processing service providers. A payment gateway obtains and stores transaction authorization. A back-end processor takes payment gateway transactions and coordinates information flows. It handles chargebacks, other reconciliation items from the interchange network, and also between the acquiring and issuing banks. And this also includes ACH, or automated clearinghouse transfers. Some processors handle all elements of payment processing, and others specialize in one element of a particular industry. A known company provides a level of comfort to buyers. Store-valued cards are a plastic card with an embedded microchip that can store information and perform calculations. Most of these cards incorporate near-field communication, NFC, technology, which allows for contactless data transmissions over short networks. This allows interaction with readers and other devices. The stored value cards can hold much more data than a magnetic card, and they're safer because data can be encrypted. They're used in Europe and Asia, but less successfully in the United States. Although the United States has seen increased use in recent years, it's still not widespread. A digital cash, also called electronic cash or e-cash. This describes any value storage and exchange system created by a private non-governmental entity. Does not use paper documents or coins. It can serve as a substitute for government-issued physical currency. With online cash storage, the consumer has no personal possession of digital cash. A trusted third party, like an online bank, is involved in all transfers and holds customers' cash accounts. Merchants will contact the customer's bank for payment. This helps prevent fraud because they can confirm the valid amount of cash the customer has. It fills a need in developing countries that rely on cash as they conduct business to commerce, business to consumer electronic commerce. It does not need to exist here in the United States because consumers already have payment cards and a well-established payment card system. Bitcoin is the most well-known provider of digital cash today. It's an online ledger system that tracks balances while participants can remain anonymous. It uses public key cryptography, and a large percentage of the uses are involved in things like speculation, but also you're seeing an increasing amount of consumer purchases. Another large amount is international movements of money. With digital cash, there's concerns about privacy and security, independence, portability, and convenience. So the particular system, such as Bitcoin, must address those concerns. One of the concerns about spending electronic cash is double spending, which is spending electronic cash twice by submitting the same electronic currency to two different vendors. If there's not enough time, then the vendors won't be able to prevent a fraudulent act. The main deterrent to this is the threat of detection and prosecution. So the system has to provide traceability back to the origin. In other words, the person who made the transaction can't repudiate it. And so if they do make two payments, it can be traced back to them and actions taken. A two-part lock provides anonymous security and also signals an attempt to double spend cash. So that's another protection. And here we see detecting double spending of electronic cash. Merchant 1 adds information and Merchant 2 adds information. They both lock that, and both transactions are sent to the bank, and the bank then is going to lock the transaction, so it sends back a message to the merchants who both have a lock on that, and it's then denied because it's a double attempt to double spend. So, some of the advantages and disadvantages of digital cash. Digital cash can be more efficient, less costly than traditional payment methods. It does not, there's no audit trail similar to physical cash, which makes it non-traceable, which can lead to money laundering. Which is converting illegally obtained money into money spendable without being linked to the illegal activity. Next, let's talk a little bit about digital wallets and software-based digital wallets. These allow customers to store name, address, credit card information on an electronic device or software. The benefit is the customer enters the information just once. A server-side digital wallet stores information on the remote server of the merchant or the wallet publisher. However, if you do that, the security breach can reveal thousands of users' personal information to unauthorized parties. And some of the famous cases were Google Wallet, Microsoft Windows Live ID, and Yahoo Wallet. Client-side digital wallet stores information on consumers' computers. But you must download the wallet software onto every computer you're going to be making purchases from. Hardware-based digital wallets are implemented using smartphones or tablets. They store the owner's identity credentials such as driver's license, a medical insurance card, store loyalty cards, and so on. And they transmit portions of information using Bluetooth or wireless transmission to a nearby terminal. Near field communication, NFC communication, can be used if the wallet is equipped with a NFC chip. If the device holding the wallet is equipped with an NFC chip. Examples include Google Wallet, Android Pay, and Apple Pay. Security and privacy are major concerns. And of course, there's a need to prevent unauthorized access. So next, let's look at internet technologies and the banking industry. Paper checks are still the largest dollar volume of payments in the world today, and they're processed through the world's banking system. Other major payment forms also involve banks. Internet technologies are providing new tools and creating new threats for the banking industry. The old method of physical check processing is the person wrote a check which was deposited by the retailer and sent to a clearinghouse to manage the funds transfer. The paper check was transported to the consumer's bank, and the canceled check was sent to the consumer. The disadvantages of this old approach include the transportation cost of mailing the checks around, and then the float, and that's the delay between the time the check is written and it clears the account. The Check Clearing for the 21st Century Act, also known as Lecture11, permits banks to eliminate movement of physical checks and use image scanning technology. So instead of getting your paper check back, you would get an image of the check. It also provides instant check clearing that eliminates the float. Mobile banks are being explored by traditional banks. So banks are exploring mobile commerce potential. Most banks offer apps for mobile devices, and these apps allow consumers to check their balances and transfer amounts between different accounts they have. It allows them to view their statements and to find an ATM. Some bank apps allow checks to be deposited by taking a picture. Vendors such as GoPayment and Square offer a tiny credit card reader that can be attached to a mobile device to take payments. So some of the threats to digital banking include phishing and identity theft. Online payment systems offer an attractive arena for criminals and criminal enterprises. Phishing attacks are techniques for committing fraud against online businesses and their customers. And of course, they're a concern to financial institutions as well. A phishing attack is when an attacker sends an email message to people with the potential for having people who have the potential for having an account at a targeted website. The email message tells recipient of the email that their account has been compromised and that the email recipient must log in to correct the problem. And it includes a link that appears to be the website logon page, but actually it leads to the perpetrator site so that the victim's log-in information can be captured and used. A spear phishing is a carefully designed phishing attack targeting a particular person or organization. It requires considerable research, which increases the chance of a email being opened by the recipient. As an example, in 2008, government stimulus checks were the victim of a phishing attack. Phishing emails that seemed to be from the IRS appeared within 1 week of the passage of the government stimulus action. The email link can be disguised by using an @ sign in the URL. So using the @ sign, which causes the website to ignore the characters before it. So you could have something like https://www.paypal.com at 218.36.41.188. And instead of going to paypal.com, the browser will be delivered to 218.36.41.188. The phony site's invisible because of the Java code. Pop-up windows can be made to look exactly like the host company they're imitating, including website graphics to make it even more convincing. So you really think you're logging into a legitimate organization, a legitimate request from someone who you deal with. Here's an example of the type of email that will be sent in a phishing email scam. Phishing attacks are also used for identity theft. Organized crime or racketeering is unlawful activities conducted by a highly organized, disciplined association. It's differentiated from less organized groups. The internet provides new criminal activity opportunities. Usually it's in the form of generating spam, phishing, and identity theft. Identity theft is a criminal act where the perpetrator gathers the victim's personal information. The goal is to use that personal information to obtain credit, and then the perpetrator runs up account charges and then disappears. Large criminal organizations can be highly efficient perpetrators of identity theft. Often they'll use a zombie farm, which is a large number of computers implanted with zombie programs. A farming attack is the use of a zombie farm, often by organized crime, to launch a massive phishing attack. Phishing needs both collectors and users of information, which requires two different skill sets. Criminal organizations increase efficiency and volume by facilitating and participating in these transactions. Each year there's millions of victims and at least $1.5 billion in lost funds. Countermeasures include efforts to control spam. Spam is a key element of phishing attacks. Okay, so any protocol changes that involve email recipients' ability to identify the message source will reduce phishing. So this is a way of looking at, we want to control spam, so we're only going to allow emails through that come from legitimate sources that we expect would be communicating through our firewall to our employees. So to fight phishing attacks, we have to educate website users, contract with consulting firms specializing in anti-phishing work, and monitor online chat rooms that are used by criminals. The incidence of phishing has grown rapidly over the past few years, and experts expect it will continue. It's been extremely profitable criminal activity. And here we see the types of personal information that are most useful to identity thieves. And they're what you would expect. All right, this concludes our Lecture 11. I'll see you on the forums.